Hello everybody, it's Ashley Garner with Ashley B. Garner and Associates at Intracoastal Realty in Wilmington, North Carolina. Today we're going to jump right in because there's a lot of stuff to talk about in a short video. This one's about cash flow investment. We've had a lot of good feedback on these videos about investing in real estate. So let's get started. This is a duplex that we think we can buy for $180,000. We know that it brings in $1,500 a month in rent, $750 on each side for a total of $1,500 of gross rent. Now we know that we can buy it with a loan of 20% down cash and borrowing 80%. So that's $36,000 down, a loan of $144,000. Now the payment on that would be $775 a month, roughly. That's your principal and interest. But we need also to add your real estate taxes, your insurance. Each of those are $125 a month. Then a vacancy rate, because the bank's going to make you calculate that in to be conservative in your investment. That's not actually cash you spend out, but just to calculate in case you have a vacancy. If you keep it rented, obviously you don't have this, but that's say $150 a month. Then a capital savings, you might want to save aside some money every month so that when it comes time to replace the roof or the air conditioner, you've got cash. So that's $1,275 that's spoken for in this, every month. Subtract that from your gross rents and you get $225 of positive cash flow every month. Multiply by 12, it's $2,700 a year positive cash flow. And divide that by 36,000 and you see you have a cash on cash return of 7.5%. Now, so here's your return, cash on cash 7.5%, which is good because if you put this cash in the savings account in the bank or a money market, you're going to make like 1%, maybe. So 7.5 is obviously better than 1, but there are other benefits. You've got depreciation. These buildings, these real estate is a depreciable asset that your CPA can use to offset some of your income on your taxes. So you're saving tax money. You've got possibly some other deductions that your CPA can find to help you with to save on your tax bill. Then you've got appreciation. Appreciation over time in the United States is somewhere between 4 and 6% annually. So theoretically, you take that 180 and add 4% to it every year that you own it, and it's worth that much more each year. At the same time, you've got a tenant that's paying you rent, you're making the bank payment, you're paying down the loan, so you've got more equity in the property. So theoretically now the value is going up, the equity or the loan balance is going down, so this amount in the middle is your equity and that increases. And that's what you want. You want to create this equity. This is your savings account, this is your investment. So the real benefit is that you've got an asset, you've got tenants that are paying you rent every month, their money is allowing you to pay for this and afford it. So every month you don't have to bring cash out of your pocket every month to own this thing. So this is the benefit. This is the simple way that real estate can create wealth for you. You can see obviously if you own one duplex and you get all this, just think if you owned 2 or 3 or 4 or 10 or 20 or 100, everything is just multiplied. And this is the way that people create true wealth. And you can do it too. There are lots of different ways to buy it. Maybe you buy it all cash or with some partners or with some family members. Maybe you have a home equity line of credit. There's all different ways to structure it. So that's why you need to give us a call. We'll run through your specific situation and we'll make you a plan and we'll get you involved and make you an investor. Until next time, this is Ashley.